What's up everybody, Chris here from Project Option, and in this options trading strategies video we're going to talk about the bull put spread. So if you're familiar with the short put strategy, we're going to talk about a strategy that is similar to that but has a little bit less risk and slightly less profit potential. So let's go ahead and get right into it. So let's start with the bull put spread strategy characteristics. So the bull put spread is actually sometimes referred to as a short put spread or a put credit spread. All these three things are the same thing, they're just different names for the same strategy. So the bull put spread strategy consists of selling a put and buying a put at a lower strike price. So both legs use the same number of contracts and the same expiration cycle. So the maximum profit potential of the strategy is the net credit received times 100, and the maximum loss potential is the width of the put strikes that you sell minus the credit received times 100. So don't worry, we're going to go through in-depth examples for all these things, but right off the bat we just need to define some of the strategy's characteristics. So at expiration, the break-even price of the short put spread strategy is the short put strike minus the credit received. Now, the estimated probability of profit on any bull put spread trade depends on the strike prices that you sell. So, the estimated probability of profit is actually greater than 50% for out of the money put spreads that you sell. Now, the estimated probability of profit is closer to 50% for at the money put spreads and is less than 50% if you sell an in the money put spread. Now, after expiration, you may have a resulting position if the spread expires in the money. So if both options are in the money, so if the short put and the long put are in the money, no stock position is taken after expiration because the exercise and assignment of the short put and the long put offset each other, and the spread just essentially settles to its final value and you don't take on a stock position. However, if only the short put is in the money, you will be assigned on that short put if you hold it through expiration, and that short put will expire to plus 100 shares of stock per short put contract. Now, in terms of assignment risk, if your short put spread is deep in the money, since you have a short put position in that spread, you have the risk of being assigned 100 shares of stock per short put if someone exercises that option that you're short. Now, that's only really going to happen if the stock price is well below your short put strike and the short put is trading with very little extrinsic value. Alright, so now that we've discussed the basic strategy characteristics, let's go ahead and look at a bull put spread example and then take a look at the expiration risk profile graph. Alright, so let's go ahead and look at an example bull put spread trade. So here we have various strike prices and we can see the put price for each corresponding strike price. So let's say at the time of these option prices, let's say the stock price is trading for $90 and we sell the 90.85 put spread. Now that means we're going to sell the 90 put and we're going to buy the 85 put. So we're going to sell the 90 put for $5.09 and we're going to buy the 85 put for $2.84. Now since we collected more than we paid out, this is going to result in a net credit for the spread. So since we received 509 and we paid out 284, the net credit in this case is $2.25. Now the width of the spread is $5. Since we sold a put with a strike price of 90 and purchased a put with a strike price of 85, there's $5 between the short put and long put. So we would say the spread's width is $5 in this case. So let's go ahead and take a look at the expiration risk profile graph for this example trade. So as we can see here, the maximum profit potential is $225, and that's realized if the stock price is at $90 or above $90 at expiration. Now that's because since we collected a net credit of $2.25, if this entire put spread expires out of the money and the short put and long put expire worthless, we keep that $2.25 credit. Now the standard option multiplier is 100, so since that we collected $2.25 on that spread, that actually results in a credit of $225 that we can potentially make. Now, in regards to losses, we know that the maximum loss potential on a short put spread is the width of the put strikes less the credit received times 100. So in this case, we have a $5 wide put spread. and we collected $2.25 for that spread. So $5 minus $2.25 gives us $2.75 that we can lose on the spread. Now if we multiply that $2.75 loss times 100, we get to a maximum loss of $275. Now that maximum loss occurs if the stock price is at or below $85 at expiration. So at or below our long put strike price. Now that's going to result in a maximum loss of $2.75 because if the stock price is below $85 at expiration, this short 90-85 put spread is going to be worth $5. Now, since we sold it for $2.25, if its value increases to $5, we're going to be out $2.75 per spread, which is a maximum loss of $275 per spread. Now the break-even price is $87.75. Now that comes from the short put strike price of $90 less the $2.25 credit we received, which gives us $87.75. So if the stock price is right at $87.75 at expiration, we're going to break even on this trade because the short 90 put will be worth $2.25 and the long 85 put will expire worthless. So if we add those two values together, 225 plus 0, we get a spread value of $2.25. So since we sold the spread for $2.25, if it's worth $2.25 at expiration, we break even. So this is just the expiration risk profile graph for this particular put credit spread. Alright, now that you know the basic characteristics of the bull put spread and you know the expiration risk profile graph, let's go ahead and take a look at 3 example trades and look at how a short put spread performs through time, because the expiration risk profile graph tells you what will happen at expiration, but a put spread will change value through time, and if you're short a put spread, you could potentially manage that trade early. So let's go ahead and take a look at how a short put spread performs through time as the stock price is changing. So here's the setup. The initial stock price is 109.96, and we're going to sell the 110 put and buy the 95 put expiring in 46 days. Now we're going to collect $9.22 for the 110 put, and we're going to pay $3.67 for the 95 put. So our net credit in this case is $5.55. Now just one more thing, the spread width is $15 in this case because we're selling the 110 put and we're buying the 95 put, so there's $15 between the put strikes. So our break-even price in this case is the short put strike price of 110 less the $5.55 credit we received, which brings our break-even price to 104.45. Now the maximum profit potential on this trade is the net credit of $5.55 times 100, which is $555 per put spread. Now the maximum loss potential is the $15 wide put strikes minus $5.55 we received in credit times 100, which brings our maximum loss to $945. So we sold the put spread for $5.55. The most the put spread can be worth at expiration is $15, which means if we sell it for $5.55 and it goes to $15, our loss will be $945 per spread. So let's go ahead and take a look at how this short put spread performs through time as the stock price is changing. So in the top part of this graph, we're looking at the changes in the stock price relative to the short put strike price, the long put strike price, and the put spread's break-even price. And on the bottom part of the graph, we're looking at the price of the 110.95 put spread and any corresponding profits or losses as the spread's price is changing. So as we can see here, the stock price rises initially, and that means the short put spread's price actually decreased a little bit. And we can see from that initial increase in the stock price, we actually were profiting as a short put trader, because if you sell a put spread, you want the spread's price to decrease, which happens when the stock price increases or time passes and the stock price is above the break-even price. Now, as we can see, that lift in the stock price did not last long, and the stock price actually fell from around $115 all the way down to less than $85, which is well below the put spread that we sold. So as we can see here, As the stock price is decreasing, the 95-110 put spread is actually increasing in value. Now, since we sold the spread and it's increasing in value, that means we're losing money as the spread's price grows and grows. Now, at expiration, the stock price is below the long put strike price of 95, which means this put spread actually settles to its maximum value of $15. Now, since we sold it for $5.55 and at expiration it was worth $15, we would have incurred the maximum loss potential of $945 in this case. Now, keep in mind that you can always close a put spread early before expiration if you want to lock in a loss or lock in a profit. So in this case, since we're short the 110 put and we're long the 95 put, to close this short put spread before expiration, we would have to buy back the 110 put and sell the 95 put in the same transaction at their current market prices. So let's say you wanted to sell the spread when it reached $10. So once it reached $10, you could just close that spread and buy it back. And since you sold it for $5.55, if you bought it back for $10, your loss would have been $4.45 per spread, or a loss of $445 per spread. So now let's look at another example of a short put spread. So we just looked at a put spread that did not make money at expiration. So now let's move to an example where a short put spread ends up with a partial profit at expiration. So here's the setup. The initial stock price is $219.28, and we're going to look at selling the 220-190 put spread. So we're going to sell the 220 put and we're going to buy the 190 put, and both options are expiring in 49 days. Now we're going to collect $14.60 for the 220 put, and we're going to pay $4.60 for the 190 put. Now that gives us a net credit of $10. So our break-even price in this case is $220, that's the short put strike, minus $10, which is the credit we received, which brings our break-even price to $210. So since the initial stock price is $219.28, the stock price can actually fall by $9.28, and we can still not lose money on this trade. Now the maximum profit potential is the $10 net credit we received times 100, which is $1,000. And since our put spread is $30 wide, the most we can lose is the $30 width of the put strikes minus the $10 we received times 100, which is $2,000. So the most we can make is $1,000, the most we can lose is $2,000. Now let's go ahead and see what happens to this put spread over time. Alright, so like before, in the top part of the graph we're looking at the changes in the stock price relative to the short put and the long put strike price and the break-even price of the short put spread. And in the bottom part of the graph we're looking at the price of the 190-220 bull put spread. And we're looking at any corresponding losses or profits as that spread's price is changing. So as we can see here, in the beginning period, the stock price fell from 220 right to 190, so it went straight to our long put strike. And consequently, that spread's value actually increased from $10 to $20. So since we sold it for $10, once that spread's price reached $20, we're now sitting on a loss of $1,000 per put spread. But the most we can lose is $2,000, so the losses aren't maxed out at that point yet. Fortunately, the stock price actually rallied back from 190 and rallied back to 220. Now once it hit 220 again, we can see that the spread's price was worth slightly less than $10, which means we were sitting on a small profit. Now the stock price actually ended up falling again, and this time just fell below the short put break-even, or the short put spread's break-even price of $210. Now at expiration, the stock price was in between our short put strike and the break-even price. So in this case, we actually did make money on the spread. So since the stock price was below the short put strike at expiration, the short put would have expired to plus 100 shares of stock if the short put spread holder held this position through expiration. So that's just something to keep in mind. So if you're short a put spread and only the short put is in the money at expiration, if you don't want a long stock position, you'll have to close the put spread or close the short put before expiration. Alright, so we've seen a losing short put spread and we've seen a partial profit short put spread. So now let's go ahead and look at an example where the short put spread realizes the maximum profit potential at expiration. So here's the setup. The initial stock price is 716.03. The strikes we're looking at are the short 700 put and the long 640 put, expiring in 67 days. Now we're going to collect $30.20 for the 700 put, and we're going to pay $12.15 for the 640 put. Now that brings our net credit to $18.05. Now our break-even price is the 700 short put strike less the 1805 net credit, which brings our break-even price to $681.95. The maximum profit we can make on this trade is the 1805 net credit times 100, which brings our maximum profit potential to $1,805. Now the put spread in this case is $60 wide, which means our maximum loss potential is $60 minus 1805 times 100, which is $4,195. So we can make around $1,800 and we can lose around $4,200. So let's go ahead and take a look at how this short put spread performed over time as the stock price was changing. Alright, so in the top part of the graph, we're looking at the stock price versus the short put strike price, the long put strike price, and the break-even price of the spread. And in the bottom part of the graph, we're looking at the price of the spread through time and any corresponding profits or losses based on our entry price of $18.05. So as we can see here, in the initial period, the stock price fell towards our short put strike price, rallied back a little bit, fell down to the break-even price, and then continued to rally from there. So as we can see here, we did have some losses at some points during this trade, but for the most part, between 30 days to expiration and 0 days to expiration, the stock price rallied and was above our short put strike price at expiration. And as such, the short put spread expired worthless at expiration, which means if we sold the spread for $18.05, we kept the $18.05 credit, which means our maximum profit in this case was $1,805. Now, you will notice that around 45 days to expiration, the stock price surged from $700 to around $775, and the spread's value actually fell to around $5. So maybe if you wanted to manage a winner early and you wanted to close the trade for a profit, you could have actually bought this short put spread back when it was worth around $5, and you would have locked in a profit around $13.05. So just keep in mind that you never have to hold a put spread or any trade to expiration. And in this case, if you wanted to close the put spread early for a profit, you could have just purchased the spread back at its current price when it was less than $18.05. So you never have to hold the trade to expiration. You can always close it early. So this is just a good example showing that if the stock price doesn't collapse through your put spread and is above your short put strike price at expiration, both of the options of the short put spread will expire worthless and you will keep the net credit, and that means you make the max profit of the spread. Alright, so let's go ahead and go over the main concepts from this video. So selling put spreads is also known as bull put spreads or short put spreads or put credit spreads. Those are all names for the same strategy. So selling put spreads is a bullish strategy that has limited profit potential and limited loss potential. So compared to just selling a put outright, by defining the risk and buying that put against your short put, you limit your profit potential a little bit more than you would if you had just sold the put, but your risk is significantly less than just selling the put outright. So a short put spread is a less risky version of selling a put. Now the max profit on a short put spread is the net credit received times 100, which occurs when the stock price is above the short put at expiration or significantly above the short put before expiration. Now the max loss on a short put spread is the width of the put strikes less the credit received times 100. And the max loss occurs when the stock price is below the long put at expiration or is significantly below it before expiration. Now, as we talked about, to close a bull put spread, a trader can buy back the spread at its current price to lock in profits or losses. So you never have to hold the trade to expiration if you don't want to. Now lastly, since you do have a short option in a short put spread, you do have early assignment risk. Now if your short put is deep in the money and it has very little extrinsic value, you're at risk of being assigned 100 shares of stock per put contract that you are short. So just know that if your short put spread becomes deep in the money, you do have the potential to be assigned early on that short put. And that's only really going to happen if the short put has very little extrinsic value remaining. Well, thank you so much for watching this video, everybody. I hope you enjoyed this video. If you found it informative, please go ahead and subscribe to our YouTube channel so that you can receive all of our videos as they are released.